Okay, well, good afternoon, everyone, and welcome to what I think will be a very interesting discussion and potential debate on the differences between these two types of pension plans, the personal pension plan and the individual pension plan. Next slide. Please pay attention to our disclaimer. All the information presented today is meant just for that information only. We're not giving advice. If you would like some advice, please reach out to us directly. Next slide. My name is David MacNicol, and I'm the president and portfolio manager of MacNicol and Associates Asset Management. Next slide. Just to tell you a little bit about us, for those who are new to our organization, we started the business back in 2001. We specialize at helping individuals with their investments. So we focus on families and not institutions. And you can see the various type of accounts that we take care of, including the new home ownership that's coming out in July. So we'll be adding that and doing a webinar on that shortly. But today we're focusing on pension plans. Next slide. Just a final comment about our organization. Our secret sauce is investing in alternative assets. And alternative assets to us mean things that aren't readily available to the general public. And these are things like private real estate, third-party hedge funds, and private equity. We've built up a very strong track record, almost 14 years now of audited results. And to the end of March of this year, we've been averaging a 10% return with this program, net of all fees and costs. And the number that we're especially proud of is our annual volatility runs at 6.8%. So when you look at those two numbers, that is much like what an old-fashioned bond portfolio looked like back several years ago. And so we're very pleased that we've been able to get decent returns with limited volatility. Next slide. Now today we've got two pension experts talking on the subject of individual versus personal pension plans. Matthew Bernard will introduce himself shortly, and then after that, JP Laporte from Integris will also introduce himself and talk about their side of the equation. Matthew is an expert on individual pension plans, and JP is a pension lawyer and has a bias towards personal pension plans. Next slide. So Matthew will start with an introduction on IPPs, and then JP on PPPs, and then they'll have a discussion amongst themselves as to the pros and cons, and then we'll have some questions. A number of you have thoughtfully written in questions in advance, so we've gone over those and be ready to go through them at the end of the discussion. And in the chat function, feel free to write any questions that you have to us today as they come up, and we'll be happy to introduce those at the end. Okay, Matthew, over to you.
Thank you, David, and thank you everyone for attending today's session. Quick introduction about myself. So I graduated from Laval University in Quebec in 2010. And then after graduating, I went to work for a pension consulting firm in Toronto for about 4 years. And then I moved back to Quebec and joined IA Financial Group, where I held various positions going from risk management to mortgage and securitization, merger and acquisition. And now I'm in the IPP team. And just to make sure that it's clear to everyone, at IA, we do support both the IPP and the PPP. They are great products, and it's really, I guess, the role of the advisor and the client to decide which product best fits their needs. So we can move to the next slide. So this slide, it's a simple slide, and it's an illustration basically that summarizes today's presentation. So if you think about an individual who wants to maximize their retirement income, the first step that they can take is basically to open an RSP and maximize their RSP contribution. But in the case you're a business owner, there's a possibility for you to maximize even more your retirement income, and this is by basically choosing an IPP, and this is where the focus of my presentation will be. But then there's an additional step that can be taken to maximize even more your retirement income in certain situation, and this is by choosing the PPP instead of the IPP. And this is where Jean-Pierre will focus his presentation on. We can move to the next slide. So what is an IPP? Well, an IPP is simply a defined benefit pension plan. You probably heard in the news over the past decades that DB plans were closing and were replaced by DC plans. And the reason that most employers were making that switch, it's because DB plans were too expensive. So if, as a business owner, your objective is to maximize your retirement benefit, then the IPP is the perfect tool for you. This is what the IPP is designed for. It's to provide maximum benefits that are allowed under the Income Tax Act in order to maximize the contribution that can be made in a tax sheltered vehicle. So for a business owner who have high income and are disadvantaged by RSP rule, the IPP is a really great tool for you. We can move to the next slide. So what are the key benefits of IPPs? The first one is that the IPP allows for larger tax sheltered investment than an RSP for most ages. And I will discuss about this point in more details in the next few slides. The other key benefit of IPPs relates to changes a change that were made in the 2019 budget, which you're probably aware of, that impacted basically the taxation of small businesses, where if you had too many income coming from your passive assets, you add a negative consequence on your tax rate. So the IPP is a really great tool to transfer some of those passive assets from your business, to a tax-deferred vehicle, which is the IPP. The next key benefit of the IPP is the opportunity for intergenerational wealth transfer for family plan. So by family plan, I mean an IPP where there's at least one participant who is a parent and one participant who is a children. So when the parent passes away and you have a family plan, you avoid the deemed disposition that would otherwise be applicable if the assets were held inside an RSP. So IPPs, for that reason, are again a really great tool. The next, you can go back to the other slide. The next key benefit of the IPP is for the guaranteed return from the employer. And what I mean by guaranteed return is the fact that when we do evaluation for an IPP, we assume that the assets are going to return a certain percentage over the life of the IPP. So when the actual return is less than the return that was assumed in our evaluation, it will create a deficit, and the employer will then be able to make an extra contribution to basically offset the negative return or the returns that were less than expected. And as you know, this is different than what you get from an RSP, where if you contribute to an RSP the maximum every year, and you take, for example, the year 2022, where basically most asset classes had a negative return, you didn't have the opportunity to make an additional contribution to offset that negative return in 2022. And lastly, every plan expenses whether the administration fees that are charged with the IPP or the investment management fees that are applicable on the assets, and obviously the employer contribution. Those expenses are all considered eligible expenses for tax purposes for the sponsor, as long as they are paid by the corporation. So you can move to the next slide. So how does financing an IPP work? So basically, there's different types of contribution that can be made inside the IPP fund. The first one is past service. So this is the type of contribution that relates to a deficit when there's a deficit in the plan, and there's a deficit in the plan when the value of the assets are less than the value of the benefits that were accrued by the participant. The second type of contribution that can be made to an IPP is the current service contribution. And this is simply the contribution that are made for the service that are accrued in the current year. The third type of contribution that can be made to an IPP is what we call the terminal funding contributions. And terminal funding contribution arises when a participant retires and there are extra benefits that are provided to the member that could not be funded by the sponsor when the plan was active. And depending on the additional benefits provided, those extra contributions could be quite meaningful. And lastly, we have the, as you can see, the AVC bubble. This is not a contribution that can be made by the sponsor, but it's rather personal RSP assets from the participant that can be transferred to this account. And the main reason why someone would want to take their personal RSP assets and transfer them inside the AVC account is because when you do that, the investment management fees for the assets that are inside the AVC account can be paid directly by the plan sponsor instead of being deducted from the plan assets. So this will ensure that the AVC assets grow faster or grow bigger than if the individual left the RRSP assets inside, I guess, an RRSP. There are also additional benefits related to that by transferring RSP assets to AVC. For example, you get creditor protection, and you get also more investment option that would not be allowed if the assets were held inside an RSP. So we can look at the next slide. Next slide, we're going to see a couple of numbers, but on this slide, basically the idea is to show you or to compare what would be the maximum contribution in 2023 for an RSP versus an IPP. So as you know, maximum RSP contribution in 2023 is a bit less than $31,000, and this is the blue line that is represented in the graph. And no matter how old you are, the maximum RSP contribution for 2023 is the same. The gray line represents the maximum IPP contribution for 2023, and you can see it's an upward sloping curve. So the older you are, the higher the maximum IPP contribution will be. And the red line is simply the intersection of basically the blue line and the gray line, and represents the age at which it makes sense to start opening an IPP in order to benefit from the higher contribution than what would be allowed under just a regular RRSP. So to give you a sense of how powerful the IPP can be in terms of what contribution can be made, let's assume that someone opens up an IPP at age 37 and contribute the maximum each year from age 37 to age 65. Also, let's assume that those contributions earn 5% per year. Let's also assume that the maximum that can be contributed each year increases by 3% each year. Then, over the period from 37 to 65 years old, the person who opens up an IPP could contribute an extra $300,000 versus the RRSP. The additional investment income that would be generated on a tax-deferred basis would be $530,000 for a total benefit at age 65 of $830,000 for the IPP versus the RSP. So as you can see, the advantage is quite significant. And of course, you need to offset this benefit by the annual fees that are paid when you have an IPP that are not applicable for RSP. But over 28 years of IPP fees, for sure, your benefit of the benefit of having an IPP versus an RSP is still significant. We can move to the next slide. All right, so again, we have a few numbers. So in the previous slide, we only look at basically the current service contribution. But when you open an IPP, it's also possible to recognize years of past service. So when you recognize a year of past service, if you don't have enough RSP room, you need to transfer RSP assets inside the IPP. So in the table that I present you, we assume that 10 years of past service were purchased. We assume that the RSP transfer that was required in order to purchase those 10 years of past service was $300,000. And we also assume that the earnings of the participant were at or above the maximum pensionable earnings for every year. So if we focus on the line where the participant is 55 years old, you can see in the second column that for 2023, the maximum RSP contribution would be a little bit less than $31,000. But by opening up an IPP, the current service cost contribution for 55 years old would be $44,600. So that's roughly a $14,000 increase in contribution that can be made simply by opening up an IPP, sorry. And then in the next column, we show what would be the contribution that could be made for the 10 years of past service that were bought. And in the case someone is 55 years old, that would be an extra, a little bit less than $121,000. So for that person, in 2023 alone, the IPP advantage over the RSP would be $134,000. So as you can see, this is quite a significant advantage of the IPP over the RSP. We can move to the next slide. I'm going to go quickly on this one. So ideal IPP candidate. So I've mentioned it before. You need to be a business owner. Ideally, you want to have high income in order to maximize those retirement benefits. And you need to be at least 37 years old and up until age 71. And the reason we put age 71 is because this is the age where you're required to start collecting a pension. So we can move to the next slide. So this slide, it's now that a participant or someone has opened an IPP, what are the options when the participant retires or terminates? So before I discuss about the options, I think it's important to understand that every retirement is different. And this is where we will be able to advise both the advisor and the client to make sure that they understand the implication of both of every option and that they choose what the best option is for them. So you can click one time. I think there's going to be the first option that's going to show. So the first option that would be possible for someone who is 65 years old, has accrued $1 million inside the IPP, and the annual pension accrued of $70,000. The first option is to purchase an annuity. This option is the one that is the least popular. I would say not even 5% of the IPP clients that we have select this option. someone would choose basically this option if their goal is to transfer the longevity risk and the investment risk to the insurance company. So in our example, to purchase a pension of $70,000 per year, the premium would be about 1.5 million today. So because there is only $1 million in the IPP fund, the participant would have two options. Either they make an extra contribution to purchase the full $70,000 pension, or they reduce the amount of monthly pension or annual pension they will receive and only purchase what $1 million can purchase with the insurance company. The second option, you can click again. The second option is to wind up the IPP and transfer the assets to a LIRA, an RRSP, or a LIF. But one thing that we need to be careful about this option is that when you transfer money from a defined benefit pension plan to an RRSP or a LIRA, there's a maximum that can be transferred on a tax-free basis, and any amount in excess of that maximum transfer value is payable in cash to the participant and is taxable income in the year that the participant receives it. So in our example, let's assume that the maximum that can be transferred tax-free is $800,000. Then the participant would receive $200,000 cash and will be paid and would be taxed on that $200,000. Lastly, the last option, it's to maintain the plan active. So the participant would receive $70,000 per year. The pension would be indexed at CPI minus 1%. So if we assume that the assets return 4.5% per year and the pension is indexed at 2% per year, we estimate that there would be enough funds in the IPP to pay the retired member up until age 83. But the advantage of maintaining the plan active is that the employer or the sponsor could make additional contribution in order for the participant to start to continue receiving the pension. And as I mentioned before, also, if your objective is intergenerational wealth transfer, again, you would want to maintain the plan active so that upon the death of the parent, then the money would stay inside the IPP and would belong basically to the kids or the children up until they decide, and the money will not be taxed up until they decide to start withdrawing the money from the IPP. So my last slide is regarding legislation. So IPPs exist since 1990, so they've been here for a long time. I know in the past people were saying that IPPs were complicated, it's difficult to administer an IPP. But recently there were some changes, legislative changes that were made, and it's a lot simpler now to administer an IPP. So I think this is an important point, because you as an advisor, I guess, your role is pretty simple. Your first role, the first thing you need to do is that if your client has an IPP, it's to make sure that they contribute the maximum that they can contribute. And then the second thing that you need to do is to provide us with the documents that we need in order to administer the IPP properly. And we take care of all the administration. So for you, that's the only two things you should be doing, and it should be simple to have an IPP. So JP, it's your turn.
Thank you so much, Mathieu. That was great. And welcome everybody to the segment on the personal pension plan, the PPP. So if we could go to the next slide. So I wanted to start going back to this chart that Mathieu presented, because it's important to know that a PPP has everything an IPP offers in it. It's part of the plan design. It's included. So there's nothing that Mathieu's talked about that we can't offer under the PPP. However, there are certain things that an IPP cannot do that the PPP can, and that's what we're going to be focusing on. So next slide. So what is the architecture from a legal perspective of the PPP? Well, it's really made up of three components, three buckets of money under one roof that gets registered with the Canada Revenue Agency. So we have already mentioned that everything an IPP has, we call it the defined benefit account. But all the great things that Mathieu kept talking about, we have it. It starts with that. Then we also have the additional voluntary contribution account, except in our case, on an annual basis, we can make meaningful contributions to that. And on top, we have a defined contribution account, which can be quite useful when you're under age 37. So let's say from age 15 to age 37 in a family business context, or when certain things happen in the life of a pension plan, which we'll show a couple of examples. Next slide. So going back to this graphic showing the maximum contributions based on your age, because we have all three types of accounts under one roof in the PPP, our clients are using the higher defined contribution limit, which is the light blue line when they're young. And then at age 37, they can switch into the IPP defined benefit limits, which is the upward sloping green line. So it doesn't matter how old you are inside of a PPP, you're always putting more money aside every year than if you were in an RSP, assuming that you're at the maximum pensionable salary. And from ages, let's say 18 to 37, 38, if you're using the money purchase of the defined contribution light blue limit, you'd be putting more money aside than if you were in an IPP. And in the context of family businesses, which is becoming more and more prevalent in our clientele, this is quite significant. Next slide. So I've shown you a graph, but let's see what it means in terms of extra wealth that can accumulate over time. So what we've done here, we have a table that shows at each age, the extra money that can be put in a PPP's defined contribution account, net of administration fees, over what an IPP allows you. And then we projected it to, in this case, age 71. I could have gone to age 83, could have gone further, but I capped it at age 71. And then I assumed a reasonable rate of return on assets of 5%. Of course, it could be higher, it could be lower, but had to pick something. So that extra money that's put to work in a tax-sheltered pension plan, above what an IPP allows you to take in, if you project it, it creates a future value. So this is the net advantage, the future value column. And so since this process happens every year until the two limits meet, meaning at age 37, here it's a little bit sooner because we've deducted fees on top, you can see that there is a significant amount of future values of extra wealth that the PPP customer will have beyond what they could have achieved had they been in an IPP at that age. And here in this case, it's about net of fees and fees, it's over $500,000. Obviously, if I had extended that period longer, the number would be much larger. If the rate of return was higher, it would be a bigger advantage, but we try to put a fairly conservative example together for you. So this is part one. So there's an absolute wealth advantage in a family context when you have younger people participating in the plan than under an IPP. But that's only half the story. The other piece is that, and we'll get to that in a few slides, is that if the parents pass away, as Mathieu was saying, and there are millions and millions of dollars sitting inside of the defined benefit component, because the children also participate in that, because they can buy back past service, for example, instead of having a deemed disposition and millions of dollars of taxes going to the CRA, that money stays inside the plan, continues to be tax sheltered, and is available for the younger generation. So not only is there an absolute wealth advantage, there's also an intergenerational wealth protection, all wrapped into one. Next slide. So, perfect segue. So in the context of family enterprise, this is where the PPP really works well. Next slide. And I wanted to kind of illustrate. So imagine a family business where mom and dad in their 60s or whatever, 50s, 60s, 70s, have been utilizing the defined benefit account, and together they each won about $1.5 million of commuted value. And now they're adding their kid and their grandkid, and they're, because those are being put on the payroll, it's a family business, so it makes sense. So they join the plan. And when they join the plan, we'll recognize a year of past service for those younger folks. But because we want to maximize the annual contributions, they're going to be using the DC, the defined contribution, and the AVC account, and put 18% of salary. So they're not penalized because of their age, the way they would in an IPP. Next slide. So there's this sort of how it works. Mom and dad, because of their age, they're using the IPP defined benefits side of the plan. And the kids do so for past service, but on an ongoing basis, they're for annual service, they're using the DC and AVC, and they're putting their 18% of salary. Next slide. So when mom and dad pass away, the $3 million that they had earmarked for their pension, for their retirement inside the plan, becomes surplus and doesn't get taxed. So now, instead of giving $500,000 to the government, the money stays with the financial advisor inside the account for the benefit of the surviving plan members, kid one and grandkid one. Next slide. So that's the beauty of intergenerational wealth transfer within a pension plan, is that there is no deemed disposition. And as such, this money doesn't flow through the estate of mom and dad. So for those of you who are in provinces where there is probate fees, estate administration tax, this is also not a consideration. We don't have to worry about estate tax with all the capital that's left behind in the plan. And if the kids and the grandkid decided that they don't need to pull money out in the form of a surplus distribution, because maybe they still have a job, maybe they have other assets, maybe they don't need the money right away, then that $3 million would continue to grow tax sheltered for many, many years. So you've got an acceleration of the wealth created. And they only pay tax on whatever surplus they extract from the plan. So that's another tax management tool that we have at our disposal. Next slide. Now, we've talked about the age advantage, which is huge, but there are other ones that come with the triple account structure of the PPP. One is the ability to do what I call dry powder. So this is where we rely on the principle that Mathieu talked about, the special payment when the internal rate of return inside of the account isn't generating the 7.5%. And there's some other assumptions, but I'm simplifying. If that happens, then of course, we're able to make additional tax deductible contributions, those special payments. So when one strategy that I particularly like is what I call the dry powder hedging strategy. So here we're utilizing the 3 accounts of the plan to their fullest. And what we do is inside the defined benefit account of the IPP, we'll go hyper conservative, like short-term cashable GICs, for example. It could be something else, doesn't matter. As long as it's not going to lose value and is highly liquid, that's what you want. And then the rest of the assets can be rolled into the ABC account if you want to just do stocks and be exposed to the markets. So next slide. Now, going back to what Mathieu was saying, if the rate of return is below a certain threshold, that's going to cause special payments, which is a second box, which allows the company to claim even more tax deductions, which is great, which is the third box. And then that extra money that's coming in, that can be used to purchase more GICs, more safe stuff. Now, when the markets do crash, which happens periodically, everyone else has lost money except our clients, because our clients are in GICs. So they can cash out those GICs or whatever it is, and then go buy stocks. But now they're buying at a discount. And when the markets rebound or grow, whatever, depending on the recovery curve, and those stocks are sold, all the capital gains are tax exempt because it's inside of a pension plan. So what we've done is we've created a hedging aspect to this. We've guaranteed ourselves a buy low, sell high strategy. And while we're waiting for the crash, we're taking tax deductions that other people can't access because they're not in a pension plan. So it's a really neat, simple, once you understand all the moving parts, way of guaranteeing wealth in up and down markets. Next slide. Now, Mathieu will be quick to jump and say, oh, well, I can do that with an IPP as well. And that's true. That's true. You could use your RRSPs for your stocks that are exposed to the markets and then use the IPP and buy GICs. That is true. But the PPP does provide a little bit of extra sort of add-on, is that if you're holding stocks in an RRSP, you know, you can't write off the investment management fees, whereas if you transfer them into the ABC account of the PPP, you can. But then again, you can fix that by transferring your RRSPs into the IPP's ABC account. So that kind of makes it very similar. And the one thing though is that if you did the strategy and you bought stocks low, you sell them high, and there's a huge rate of return, that causes a problem for both the IPP and the PPP's defined benefit account. I don't know if it's a problem or not, but it causes a contribution holiday typically. And therefore, you can't continue to make contributions. Whereas with the PPP, you can always switch into defined contribution mode, and then the next year start putting money in your RRSP. You could do that with an IPP as well, but you'd probably have to file a plan amendment to freeze accruals. And then if you wanted to reopen the system once you're allowed to contribute again, file another plan amendment to unfreeze the accrual. So you can get there. It's a little more clunky. With the PPP, it's very very simple. Next slide. Now, one of the things that, and this has nothing to do with tax optimization, it's more the structure of the plan. It's the concept of fiduciary oversight. So Integris, our firm, has a number of pension lawyers on staff that supervise and help our clients optimize their plan and deal with the CRA if there are issues that might come up, or try to spend a lot of time helping accountants and financial advisors and financial planners with understanding this area of the law. And Integris acts as a fiduciary. Now, fiduciary is an old concept that comes from English trust law. So it goes back centuries. And what it does is it really holds us to the highest standard of care provided by law. So, you know, the lowest standard is what we call caveat emptor, buyer beware, right? Everybody's defending their own sort of objectives and their own interests, and then you just have to negotiate. And we're not at that. We're at the highest level. We're at the fiduciary standard of care, which is, by the way, the standard of care that MacNicol and Associates, when it's investing money on a discretionary basis, is also held at that level. So that changes things a little bit, because it forces Integris to always act in the best interest of the clients. And when you typically sign up for an IPP with an actual service provider, these actuaries are not held to the fiduciary standard of care. And I've seen the service agreements of certain firms, specifically out west, where they have clauses that says you cannot sue us in class action litigation. If you have a problem, you have to sue us in Calgary. You must come to our court, fly from Newfoundland to start a claim for $5,000 in Alberta if you're not happy. I mean, stuff that you would never see in our documentation, because they're not held to a fiduciary standard of care. So it's the devil's in the detail, and it's really important for people to know that, but nobody knows, nobody reads the fine print. So they think that an IPP and a PPP is the same thing. They have no clue that it's quite different, as we've shown you up to this point. Now, if you wanted access to pension lawyers and you had an IPP, you'd have to purchase that service separately. So when people compare the annual fee of an IPP to a PPP, they're missing that could be some additional fees out there that are not disclosed, which is misleading, but it's not in the best interest of the client. So let's move on to the next slide. So what are some of these fiduciary oversight services that comes wrapped into the PPP? One is dealing with practical situations, like what if there's a marriage breakdown and then the ex-spouse now wants to split the pension, and you have to go through a whole process and coordinate with the actuary and deal with the lawyers for the agreed parties, right? All of that is all extra, right? It's not covered typically by the annual IPP actuarial fee schedule. There might be some exceptions, but typically what I've seen is not. Applications to extract surplus assets, depending on the jurisdiction. There's a lot of extra paperwork and dealing with regulators. You need pension law expertise for that, unless you have that in-house. Corporate law support in the sale of a business. A lot of business owners want to sell their business. Well, those are pretty sophisticated corporate tax and corporate law transactions, and the pension plan is something that needs to be factored in. So I've been doing a couple of deals just this week of people selling their business and transferring their plan to their holding company. That's all of that expertise is valuable, and typically you'd have to pay that out of pocket unless you want to do it on the back of a napkin. And then the tax optimization reviews. So, you know, the checklist where we say, do you have children that were recently hired? Can we add them to the plan because they're not penalized based on their age? The market has tanked. Should we do an ad hoc actuarial evaluation to allow you to do special payments? Should we set the dry powder hedging strategy? Yes or no? Et cetera, et cetera. So lots and lots of services and value that's typically very expensive if you purchase this separately. Next slide. Also, part of our mission is to help other service providers, like accountants, financial planners, financial advisors, to learn about the pension world, because virtually nothing's taught out there. And so we've created an advanced knowledge center with a whole bunch of courses that are offered through the Knowledge Bureau out of Winnipeg. And this allows people who don't get this in their normal traditional training to become much more familiar with all the advantages that Mathieu was talking about when it comes to IPPs and PPPs. Next slide. So I'll give you some examples of how we've helped financial advisors and other tax professionals. So, for example, a lot of clients are becoming non-residents of Canada, and they're wondering what's going to happen to their pension assets. So we talk about the fact that pensions are exempt from the departure tax. Transfers of international monies in other countries, how can they move that into Canada without paying tax where possible? Using prescribed annuities where you don't pay that tax that Mathieu was talking about when you wind up the plan. You know, that maximum transfer value. There's a way of avoiding that if you purchase a special kind of annuity under Section 147.4 of the Income Tax Act. So that's something that, you know, few people even know about, let alone act on. The use of the capital dividends account when assets are sold in order to fund the plan. So that's something that a lot of people often miss. Using permanent life insurance products as an asset class within the PPP, because it comes with a death benefit. And then using the plan to purify the shares when a shareholder wants to take advantage of the lifetime capital gains exemption. So all of these can get very sophisticated, and it's teamwork. The accountant has to be on board, the financial advisor, the client, and the lawyer sometimes. So to have this pension knowledge in-house is extremely valuable to the client, but they don't know what they don't know. Clients don't know what they don't know. So they think that, you know, they don't even know that they can do any of these things. Next slide. So just to wrap up, because it's already 12:48 and we wanted to reserve time for questions. To conclude, there is nothing that an IPP can do that a PPP cannot do just as well, because it's already part and parcel of the architecture of the PPP. However, as we've talked about, the reverse is not true. So anyone that tells you IPP, PPP is exactly the same thing, it's just a marketing gimmick, they're lying to you. And unfortunately, I've seen it in the press, I've seen it on social media. It's very disheartening to see how some people are extremely unprofessional and are lying to the general public. And an IPP does not automatically come with fiduciary oversight. You know, if you want to have that pension governance oversight, typically you have to pay extra. But forget about the IPP versus PPP debate for a second. The real debate, and I think Mathieu would agree with me, is not whether a PPP is better than an IPP. The real debate should be, why on earth are 98% of the marketplace still using the RRSP when they really should be doing upgrading to any kind of pension plan, whether it's an IPP or a PPP? There's only 2% of the market that has caught on. And that's the real debate. That's the real issue that I can't understand, and that we're going to sort of discuss a bit further. Next slide. So just to wrap up, my argument is that it is critical for business owners, as long as they're under age 71, and as long as they're taking T4 income out of their business, it is critical for them to upgrade from their RRSP, if that's what they're using to save for retirement, into either an IPP or a PPP. I couldn't care less, because we can also administer IPPs. But for business owners, where you have multiple generations on the payroll, my contention today is that it is critical or recommended, maybe recommended, to upgrade from an IPP to a PPP to take advantage of that age and all these other advantages that come with having the triple account structure. Next slide. So that's it for the formal presentation. I think Mathieu, you're back on. So any thoughts before David starts taking the questions?
No, I think I'm good, Jean-Pierre. And I don't know, Jean-Pierre, can you see the question? I think I see a few questions, and I think there's a few good ones in there.
Okay, let's hear them.
So, and I think you briefly touched it at the end of your presentation, but if a business owner only receives dividend income, is an IPP a consideration? That's a really good question. No, like one of the criteria to be able to open up an IPP and be able to recognize service is to have T4 income. So if you only receive dividend, those dividends are not going to be we're not going to be able to recognize that as earnings.
Yes, but the fact that someone has always taken dividends up to this point does not preclude a change, and switching to some T4 income, some salary, some bonus, the balance could still be dividends, and then put a plan in place. So you don't have the past service, but you'll have the current service, the special payments, the fee deductibility, the terminal funding, and all the other advantages, plus the ability to pass whatever you put in to your children on death if they're part of the plan. So for those of you who are only the dividends, unless you're past 71, it's not too late to change. Next question.
Okay, here I'll jump in, guys.
Thanks,
Very
David.
good presentation from both of you, and yeah. So any just sort of inner dialogue. This was meant to be sort of as a debate, but it's not really a debate. It's more just a presentation of what each plan does, and then people can choose what works the best for them. JP, you were alluding to this towards the end of your discussion, and maybe Matthew can answer it as well. Why is it that every business owner in Canada does not have an IPP or a PPP? Maybe Matthew, do you want to start?
I think maybe there's a misconception that IPPs are complicated. IPPs and PPPs are complicated, but that's not true anymore. Legislation changes were made, and it's a lot simpler to administer IPPs and PPPs now. So I think that would be the main reason I would think why not that many business owners have IPPs or PPPs.
I would add to that I think a lot of people have listened to advice that says, don't take any salaries from your business. Just plow everything in retained earnings or dividends if you need money forever. And therefore, the concept of any pension plan becomes impossible. So those people who followed that advice for the longest time, thinking they were doing well by their client, were actually hurting their clients, at least since January 1st, 2014, when the legislation shifted and the pendulum swung back in favor of some salaries versus all dividends. For the last, 7-8 years, it is no longer tax preferable to do full dividends. That's without counting all the advantages of a pension plan. This is just on a pure dollar-to-dollar basis. So those who haven't read the memo yet or still pushing 100% dividend are really hurting their clients.
Yeah. Okay, excellent. Here's a quick question. Is T4A bracket commission income eligible?
No, because it's not employment income. It's not based on the employment relationship.
Okay. Okay, excellent. Are IPP and PPPs eligible for IA loans?
Mathieu,
Mathieu, maybe you do it.
It's a good question, and I don't think they would be eligible for IA loans, but I'm not 100% sure.
All I can add is that if a corporation borrows money, the interest that's paid to the lender by the corporation is tax deductible, as well as the contributions to the pension plan, which you can't do with an RRSP or a TFSA. You're not going to get a write-off on the interest when you borrowed money to contribute to an RRSP, but you do if you're in a pension plan.
Okay. Here's a cross-border tax question. What if the client is a dual citizen of the U.S.? Does the IRS treat these plans similar to our RSPs?
It's actually better than RRSP. The pension plans are treated as superannuation plans under the Canada-US Tax Convention. So if you file a W8BEN.E exam form with the IRS, the growth of the assets inside the pension plan, even if you invest cross-border, is tax exempt by the Department of the Treasury. Of course, it's tax exempt in Canada, that's a given, but even the US will treat it as if it was the General Motors pension plan and will not tax it on the growth. So we have a lot of, well, not a lot, but we have some dual status persons, you know, people that have a US citizenship and are Canadian residents, and they're able to join the plan and they don't have headaches with the fact that their corporation is putting money in Canada in a pension plan.
Okay, excellent. What is the minimum income for candidates to IPP and PPPs?
I can go with this one.
Yeah, go ahead, Mathieu.
I mean, there is no minimum, but because when you set up an IPP or a PPP, you incur additional fees versus an RSP, you need to have an income that is high enough that will at least offset those additional fees versus the RSP. So I would say anything above $100,000 would make sense.
So I think that answer is right for a single person IPP, for example, or even PPP. We typically say it's 70,000 for us, but it doesn't matter, 70, 100 salary. But if you have a family plan, the children could be on minimum wage.
Mhm.
Doesn't matter what they're getting paid, because the intergenerational wealth transfer that comes with the structure of the plan is going to save the family technically, you know, potentially millions of dollars. So it doesn't really matter if on an annual basis you're optimizing, because big picture, you'd be silly not to do it. So it's a bit of a trick question.
Mhm.
Depends. The answer is it depends.
Right. Here's one. Are PPPs legitimate? CRA seems to only refer to IPPs in their bulletins.
Yeah, so great question. Group RSPs is not an income tax either, so I guess they don't exist, right? Group RSPs doesn't exist because it's not an income tax act. And holdco is not defined in the income tax act, so I guess holdcos don't exist and they're not legitimate. Now, the answer, of course, is that PPPs, when you register a PPP with the government, the form that we have, the T510 application to register a pension plan, has a box that says, describe what this is. And one of the boxes that we fill out is IPP. So because it has a defined benefit component in it, and because the definition of IPP includes defined benefit and others, we are caught by that from a legal perspective. So the answer is, of course, the PPP is legitimate, even though the acronym hasn't been embedded into the legislation. Just like Group RSP is not in the legislation, and Holdco is not in the legislation, doesn't make those concepts that the industry uses not illegitimate, right?
Right. Okay, good answer. Conflict of interest questions. There's a couple here. Is there not a conflict of interest acting as a fiduciary and being compensated by investment fees?
No, and the legal answer for that is look at the Teachers' Pension Plan of Ontario. They are the money managers for the assets of the pension plan. So they have to act as a fiduciary. So they have to act with the best interests of the plan members at heart. That's the fiduciary standard. But they're compensated based on assets under management. So there's absolutely no conflict between getting compensated on assets and acting as a fiduciary.
Okay, excellent. Here's a follow-up. Who enforces the claim of fiduciary duty in Canada?
Well, it depends. If the plan is registered with a province, the superintendent of pensions in the applicable province could, under its enforcement powers, get involved. But typically it would be the plan members who have suffered a loss. They could start a legal action against the fiduciaries if they're aggrieved in any way, if they've lost money because of the actions of the fiduciary.
Okay, a couple more, and then we should sign off here because we're right through the hour now. Please comment on a member retiring offshore. You might have done this a bit, JP, but maybe the two of you could comment on that.
Mathieu, do you want to start?
Well, you can go ahead, JP.
Okay.
I'm not familiar with that question. Thanks.
Okay. Yeah, so this is a great question, by the way. Thank you, David, for capping it off with this question. One of the amazing things about receiving a pension from a registered pension plan when you're offshore, when you're a non-resident of Canada, is that under Part 13 of the Income Tax Act, normally there's withholding at source on that annual pension or monthly pension set at 25%. However, because Canada has signed tax treaties with about 100 different countries, and they've agreed, the two countries have agreed to only tax that pension income at 15%, which is a 40% drop in taxation from 25%. That's a really, really light level of Canadian taxation at source on that Canadian pension when you're a non-resident. But certain countries, like for example, Portugal, has said if you move to Portugal and you become a non-resident and you're relying on Canadian pension income, we won't tax you under Portuguese income tax rules on your Canadian pension. You will only get taxed by Canada at 15%. So for people who were planning to retire to sunnier climes and would like to minimize their tax burden, this is a huge, huge advantage that comes from being in a pension plan.
Here's a question. Can funds inside an IPP/PPP purchase life insurance as part of the investment inside?
Yes, yes. So that's one asset class that is possible. Just like you could buy an individual seg fund contract with a capital guarantee and a monthly or annual reset. That's another type of investment contract that's open to pension dollars. So you can also buy perma life insurance, which of course comes with a death benefit, which should something happen in a family context, you could have an injections of millions of dollars from the life insurance carrier because you have this specific type of asset. So extremely, extremely powerful stuff that most people don't know about.
Okay. What is the cost difference between an IPP and a PPP?
So it really depends, because we have certain portfolio managers that when the clients appoint the portfolio manager, we can get a referral fee, and we can use that referral fee to make the annual PPP fee zero. So that's one extreme. And then depending on whether you're using an insurance platform like Industrial Alliance, then the differential between the two is not that big. And then if you're using a trust platform, I can't speak for all the IPP providers in Canada, but I ballpark 1,600 to 1,800, whereas our fee for a single plan member is 2,800. So there's a, rough, let's call it $1,000 extra. But remember what I said, if you wanted to get the fiduciary oversight and the pension lawyers, you'd have to buy that separately with an IPP. So I used to charge $600 per hour, not $1,000 per year difference. My time was valued at $600 per hour. So you can imagine how an IPP can get expensive if there's anything that needs specialized expertise for.
Okay, let's wrap it up here, gentlemen. A good point here. Any remaining questions that we didn't get to, I will forward to JP and Mathieu to respond back with an answer. And another comment was, will we be providing a copy of this presentation? Yes is the answer. If you're on this distribution list, then you'll get a link back to this shortly. Please share it with other people. And yeah, we're here to provide this information, and my firm's here to hopefully help out with the investing of these plans. And we're indifferent as to whether it's an IPP or a PPP. And an excellent presentation today by both of you, so thank you very much. And any final comments before we all sign off?
No, just wanted to thank you for giving the industry a chance to learn about this stuff, because there's not a lot written on it, so it's nice to have these types of opportunities.
Yeah,
You're welcome.
Thanks, David, for the opportunity. And I think if there's one thing people need to remember is that we need to find those business owners that currently don't have an IPP or a PPP and are only accumulating assets in an RSP, because this is not the most efficient way for them. So we really need to get those business owners up to date with the PPP and the IPP.
No, I think it's very, very worthwhile for business owners to look at this and educate their accountants, because that's perhaps the steepest part of the learning curve, is getting the accountants on side and knowing that they've got another planning tool for either one of these plans over and above what the accountants are already doing for them. Okay, thank you. So the final comment here is our next webinar. We've got Raoul Paul from, he's the co-founder of Real Vision. And for those of you not familiar with Real Vision, it's a site that rather than just reading research as we've done in decades past, they've really upgraded things where all of their research is done via video and interviews, and they get some really deep, talented money managers from throughout the world. We are an investor in Real Vision through our alternative platform, so we have a vested interest to see that they do well. But Raoul Paul will be leading us with a macro discussion on Monday, May 29th. Ken, do you want to just go ahead and do Raoul's introduction, and then we'll sign off? No, unfortunately, the audio is not coming through, Ken. So tell you what, everybody who's on the call still and listening to this later on recording, just reach out for a copy of this or an invitation to the webinar. And I promise you, it will be something of interest, as Raoul does a lot of deep work in the macro space. And we're all trying to understand where we're going next in these crazy markets. Okay, everyone, thanks for your time. Bye-bye now.